Yeah, in 2026, if Bitcoin gets to 200 or 250,000, it would be breaking the 4-year cycle. So that's sort of part of our view is that this, if you follow the 4-year cycle, Bitcoin should be down this year. But I think that there's tailwinds that are building. And part of it is we kind of reset leverage on October 10th with that big shock.
Right.
And now I think there is still institutional adoption taking place, and Wall Street is still building a lot of products on the blockchain. And then we have US government support. So I think these are tailwinds that help Bitcoin recover this year. It does look like gold rallies typically lead Bitcoin rallies. So I think it's been healthy for gold to rally. Part of it's, dollar debasement. And now with monetary easing, those are things that are supportive of crypto to follow. And as you know, crypto adoption rates are still quite low. So crypto has sort of an exponential growth opportunity because the adoption is increasing.
Bitcoin sits at a crossroads right now, and what happens next could determine whether it breaks free to historic highs or crashes back down with everything else. The price hovers around $90,000 after a brutal end to 2024, and serious questions are piling up. Can Bitcoin actually hit 6 figures in 2026, or is this just another setup for disappointment? The answer depends on forces way bigger than Bitcoin itself, and most people are not paying attention to what is really moving beneath the surface. Wall Street analysts are already calling for another big rally in 2026, and that alone should make anyone nervous. When everyone agrees the market is going higher, something usually goes wrong. The Wall Street Journal ran a headline saying experts expect the rally to keep going, and that is exactly the kind of thing that shows up right before a correction. Markets do not reward consensus, they punish it. So when someone steps up and says we are headed for both a massive rally and a brutal correction in the same year, that deserves attention. Tom Lee from Fundstrat is making one of the boldest calls for 2026. He says the S&P 500 will hit 7,700 by year's end, but only after a 15% to 20% correction that will feel like a bear market. He also predicts Bitcoin will break its 4-year cycle and reach $250,000, even though most people think this should be a down year for crypto. His reasoning has nothing to do with hype or hope. It is based on what he sees happening with the Federal Reserve, tariffs, and institutional adoption that most people are completely ignoring.
Compressed in 1 year will be joy, depression, and rally, right? I think just like last year, in 2025, we had a terrible start. People got very gloomy. Then we had a nice rally to finish the year.
You mean April was the peak
April was the low.
The Liberation Day. Yeah.
So I think because, the market will test the new Fed, that probably is the reason we have some fear this year. But there's a lot of things to be optimistic about. The tariffs are anniversarying. The Fed is cutting. And, the ISM could finally turn back above 50, and that's good news. And we are pretty optimistic about some groups that have lagged, like energy is one of our top sector picks this year.
With the Mag 7.
And the Mag 7 should still keep producing good earnings growth. Mm-hmm. And then the financials and small caps. So it's like a lot of things that could go right in the market. I think earnings will do even better.
And the multiple comes down.
Yeah, so it's because other sectors are re-rating, but the Mag 7 might just track their earnings growth. So that'll pull the overall PE down. You can bleep me out, too, if I just say the number.
Yeah, that'd be good for you. That we don't care. I'm trying to protect you. 250. Yeah. Not $250, which some people still have as a forecast.
So, in 2026, if Bitcoin gets to 200 or 250,000, it would be breaking the 4-year cycle. So that's sort of part of our view is that this, if you follow the 4-year cycle, Bitcoin should be down this year. But I think that there's tailwinds that are building. And part of it is we kind of reset leverage on October 10th with that big shock.
Right.
And now I think there is still institutional adoption taking place, and Wall Street is still building a lot of products on the blockchain. And then we have US government support. So I think these are tailwinds that help Bitcoin recover this year. It does look like gold rallies typically lead Bitcoin rallies. So I think it's been healthy for gold to rally. Part of it's, dollar debasement. And now with monetary easing, those are things that are supportive of crypto to follow. as you know, crypto adoption rates are still quite low. So crypto has sort of an exponential growth opportunity because the adoption is increasing.
You even think that an improving ISM is bullish for crypto?
It is. For whatever hard to explain reason, we found that copper to gold price ratio, when that rises, that coincides with Bitcoin rallying. And we also found that the ISM, as it moves from below 50 to its peak, has coincided with Bitcoin entering its sort of rally stage. It has been sort of surprising how badly oil's done. I know our technician, Mark Newton, thinks oil could actually see something like 40 early this year, but that won't necessarily hurt the stocks because I think the equities have been lagging for so long. I mean, if you look at
the big majors, you mean?
Yeah, so the majors should do well. So I think energy stocks are going to start discounting higher oil even as oil gets to 40. The small caps made an all-time high last year, which is great because that's been a long time coming. And lower interest rates helps them, monetary easing. Earnings growth is starting to look better. And if we have mergers, I think all of these are tailwinds for small caps. And of course, small caps should have been tracking EM stocks. EM did really well last year. Small caps are just finally catching up. I didn't have any expectations, but it's always a good sign to be strong out of the gate, as you know, because what markets do in the first week or so give us a hint for how markets are shaping up for the year. Our base case was a rally, maybe to start the year, and then a big correction, and then a rally at the end.
A big correction, if not a bear market.
I think
those are your words, not mine.
Yeah, I think there'll be a point this year where it's going to feel like a bear market.
Yeah.
Energy materials are doing well. The Mag 7's catching a bit, and crypto's doing well. But healthcare's strong, financials, industrials are strong, and small caps. I mean, it's sort of a broad market. I think for investors and for institutional investors, breadth being good is always a good sign, actually.
Is it sustainable? Is this the way it's going to look for a little while?
Well, I do think there's a couple of sort of macro tailwinds that should help stocks. One is I do think that the economic clarity is better because the tariff disruption is more in the rearview mirror, even though we could get that overturned. But in general, tariffs aren't going up. They could be flat or down. And the second is the Fed is really turning into a tailwind because the Fed is leaning dovish. They're focused on the job market. QT is over. We have a new Fed coming. And so all of these are, in some ways, I think, and they're not fighting inflation anymore, a put for the equity market.
What happens if SCOTUS strikes down the tariffs? Is that a positive or negative for the market?
It's a source of confusion. It's going to depend on how they word their decision because, there may be refunds involved and claims. And of course, we know the White House will seek to re-implement the tariffs. But I think on balance, it means that we put a ceiling on the tariffs, that they aren't going to be higher, but there's a chance they're lower. That's a net positive. Now, some investment firms have already been buying refund claims. They're offering to buy these claims from companies at 30 cents on the dollar. So in some ways, the economy is pricing in some of these refunds. As you know, S&P earnings is a mix of all the 500 companies. But I think in 2026, earnings quality is going to be stronger because revenue growth is increasing and the rate of earnings growth is higher. So you have both top line improvement and margin expansion. That should support multiples to actually be higher. As you know, one of our themes is that we think financials are going to be re-rated more like tech stocks over the next few years because they've proven that they earn money through the cycle. They're big winners of AI, especially the ones that are tech forward. And they have expanding margins and they benefit from lower rates. I mean, in some ways, I think they're pretty undervalued right now.
What about tech? Since you bring it up and so much focus is on it, how do you feel about that right now?
I think the earnings growth is the reason you stick with tech because these are companies with really good market position, good earnings quality, but we just don't necessarily say the multiples should go up. So I think it's sort of like earnings growth with flat multiples means they still can do pretty well. Let's say the S&P's earning growth is 16. Well, if something's growing 25 or 40%, you'd need a lot of PE compression to underperformed the S&P. So I still like tech, but I do think groups like energy and basic materials, which have been really terrible for the last 5 years, can actually outperform tech. Well, I think that this is a year not to be defensive. And then, of course, as you know, Washington picks winners and losers. Last year, it was bad for consulting firms and bad for healthcare. It sounds like it could be bad for the housing, institutional housing buyers. So I think you've got to be careful about what Washington deems as winners and losers.
Lee explains that 2026 will compress an entire market cycle into 1 year, with joy, depression, and then another rally all packed together. The Fed is turning dovish and focusing on jobs instead of fighting inflation. Quantitative tightening is over, and a new Fed is coming in. All of that creates what he calls a put for the equity market. He warns that the correction will test the new Fed, and when it happens, it will feel severe. But that moment is when real opportunities show up for those who understand what is actually driving the market. Meanwhile, Jack Mallers cuts through the noise with something most people are missing. He explains that Bitcoin got trapped in a negative doom loop where everyone was obsessed with the 4-year cycle and bears kept calling for a crash to $50,000 or even $10,000. But Mallers stayed consistent with a simple message: Bitcoin is priced on the expectation of future fiat currency debasement. It is a combination of tech plus fiat liquidity, and Bitcoin moves when they print the money, not before. He points out that quantitative tightening just ended after 195 weeks, the longest QT period ever. Bitcoin battled through the longest period of monetary restriction in history, and now the Fed is expanding its balance sheet again. Now let's hear directly from Jack Mallers.
In Q4 2025, you had this kind of macro growth scare and shutdown. So the government shut down, which led to there being no economic data. When there was no economic data, there was a growth scare of like, is the economy growing? Are we entering a recession? All right. And then there was a lot of lack of liquidity for that reason. The TGA, the Treasury General's account, hit over $1 trillion. And so risk started, it became risk off. Bitcoin started to bleed and lead its way down. And then Bitcoin kind of found itself in this self-fulfilling prophecy, in this negative doom loop where everyone's like, oh, 4-year cycle, and this is the top, and having. And, you know, all the bears were saying, we're going to 50K, we're going to 10K. And I was very consistent. And I said, listen, Bitcoin is very simple, guys. It's priced on future expectations of fiat. Bitcoin is some combination of tech plus fiat liquidity. Okay? And Bitcoin's going to move when they print the money. It's not going to front run it like gold, because Bitcoin, like gold is getting, you know, foreign sovereign state trade surpluses piled into it. Like China's like putting $500 billion of trade surplus into gold. They're like remonetizing because they're worried about getting sanctioned by the US. Russia already did get sanctioned. That's not, Bitcoin's a $2 trillion asset. It's not a $40 trillion asset. It's not there yet. Bitcoin is very simple. More fiat, higher Bitcoin price. That's it. And so I've been very consistent. QT just ended. The Fed was tight. The Fed was making the dollar scarce for the last 3 years. For almost 4 years. We had you've heard Trump and Lutnick and all these guys say we had the highest rates in the world. So what's coming in 2026? Rate cuts, housing crisis, Fed's expanding their balance sheet again, fiscal stimulus in 2026. We've got the big, beautiful bill. We've got new fiscal bills, supposedly. Now we've got Project Venezuela. Trump's being like, we're going to go into Venezuela and spend the money and use those resources. Who's paying for that? We are. You, the dollar holder, the American taxpayer, you're paying for that. We've got stimmy checks. So what is Bitcoin reacting to? What are assets reacting to? The debasement trade is well and on because there's only one way out and they gotta print the money. It's not about oil. This is not about fentanyl overdoses, although no one likes fentanyl overdoses. That's not what this is about. This tweet, every BTC top is in QE, every BTC bottom is in QT. Then this tweet starts to talk about shitcoins and stuff, and you guys know how I feel about shitcoins. But the point is that I want to point out here, we're 195 weeks into the longest QT ever. Bitcoin just battled through the longest QT ever. So people say like, oh, why isn't Bitcoin found a high in this 4-year cycle? Well, guys, because the Federal Reserve was shrinking its balance sheet for the longest it's ever done. Because here's what's misleading here is like Bitcoin did go up during quantitative tightening. And you ask yourself, well, why is that? It's because the dollar continued to get debased through fiscal dominance. The spending came from the U.S. Treasury, not from the central bank. You guys have heard me go on and on about that, blah, blah, blah. But, what I think is interesting is if you take the QT, QE cycles over gold, it tells a very interesting story. You can see QT is here in red. So we made an all-time high in gold. So Bitcoin was what? It looked like between 15 to 20 ounces of gold per Bitcoin. And then quantitative tightening, fiat money became restricted, liquidity got low, and we bottom out in gold. And this is a new cycle of money printing. Now, it's important for me to point out, I don't think the money printing will be called QE because it's politically dangerous to call things QE now because we all know what QE is. So when the Fed said they were doing buybacks, remember they said, that's not QE. Yeah, but your balance sheet is expanding. So liar. So whatever they call it, I'll put a green box, for in the future for whatever they call it. It's not going to be called QE. But anyways, we had QE, okay, after COVID, and Bitcoin found a blasting new high against gold. It went all the way up to over 30, it was like 35 ounces of gold for one Bitcoin. And then we've entered QT, and Bitcoin has just been ranging in this area. Again, guys, I don't know how else to say it, so maybe I'll show it. QT's over. You see that turnaround? QT's over. This blue line's going back up. And yeah, according to their little buyback program, it will get above 7 billion, but I guarantee you this thing makes new all-time highs in 2026 or 2027. There's no doubt. There's no doubt. Has to happen. I'm telling you, Bitcoin hasn't been in a bull market yet. They haven't really printed the money. Yes, it's up in dollar terms, 126,000, but if you adjust for inflation, Bitcoin hasn't broken 100K yet. It's not a real bull market. We're just exiting the bear market. And sentiment is insane. I mean, Bitcoin erased all of its 2025 losses in like one day yesterday.
Mallers explains that Bitcoin has not yet been in a bull market. Yes, it hit new highs in dollar terms, but if you adjust for inflation, Bitcoin has not even broken $100,000 in real terms. He says we are just exiting the bear market, not entering a real bull run. The Federal Reserve's balance sheet surged over $24.5 billion in the week ending December 24th, the biggest jump since the March 2023 banking crisis. The Fed is projected to buy $35 billion to $55 billion in Treasury bills each month in 2026, bringing total purchases to about $550 billion and pushing the balance sheet back above $7 trillion. Mallers make it clear that the money printing is coming back, but they will not call it QE because that term is politically toxic now. When the Fed said it was doing buybacks, it claimed it was not QE, yet its balance sheet kept expanding. Whatever they call it in 2026, the result is the same, more fiat currency creation, and that means higher Bitcoin prices. He points to wartime financing, the housing crisis, fiscal stimulus, and plans for Venezuela as proof that the spending is about to accelerate. Rate cuts are coming, the Fed is expanding again, and the debasement trade is back on because there is only one way out, and they have to print the money. Lee connects Bitcoin to movements in gold and copper. He explains that gold rallies typically lead Bitcoin rallies because both respond to dollar debasement and monetary easing. Right now, gold is doing well, and that sets the stage for Bitcoin to follow. He even points to the copper to gold price ratio. When that ratio rises, Bitcoin tends to enter a rally. Mallers adds that Bitcoin over gold has bounced off a technical level hit only 5 times in history, and each time it marked an absolute bear market bottom. During quantitative easing, Bitcoin surged to over 35 ounces of gold per Bitcoin. During QT, it ranged between 15 and 20 ounces. Now that QT is over and liquidity is coming back, that ratio is ready to explode higher again. Lee admits that following the traditional 4-year cycle, Bitcoin should be down in 2026, but he says the cycle is breaking because fundamentals have changed. Institutional adoption is accelerating, Wall Street is developing blockchain-based products, and the US government is showing support. Lee is doubling down with a $250,000 target despite missing his 2025 call. Mallers is equally confident that Bitcoin has not even started its real bull market yet, because the money printing that drives it has barely begun. So the real question is whether Bitcoin can break free from its old patterns as the correction arrives and the rally follows. Lee says the decisions made during that chaos will separate those who prepared from those who panicked. Do you think Bitcoin could hit $250,000 in 2026, or is it just another failed prediction? Please drop your thoughts in the comments below. Thanks for watching. Don't forget to like and subscribe.